Hello everyone and welcome to your Glassnode video report for week 28, 2022. So what we're looking at this week is really, as we've seen this bear market carry on, we're starting to get down to a level where capitulation levels and maximum financial pain is really starting to creep into the market. Now, again, this doesn't mean that the bottom is in place, but what we can start to look at is the human behavior, the overall behavior of network participants. How does that compare to previous cycles? And really trying to map out, even if we do have these capitulation signals, what else can we draw from the data? Now, as this market continues to decline, what eventually happens is it puts an increasingly large volume of people under financial stress. Now, we saw that over the last couple of weeks, we obviously broke below that 30,000 level down to the 20,000 range. And what we saw at that point in time is all of the 2021 to 22 cycle holders are now underwater. Now, increasingly, we're seeing folks like the longer term holders. These are people who've held their coins for longer than 5 months. They are increasingly coming under pressure. And we're also seeing that in the mining cohort. Miners have bet very, very big and very long on Bitcoin, having bought all of that hardware, which its only job is to mine Bitcoin. So what we're going to really assess here is how this is similar to our previous bear cycles. What are we seeing in terms of the overall recovery that's going on? And what does this financial pressure look like in terms of these long-term holders and Bitcoin miners, who really are two of the longest term view, longest time horizon, really Bitcoin's strongest hands. So as usual, please do give us a like, a share, and a subscribe. It really does help this channel get to more people. Hopefully you find this session useful. Really going to be deep diving on what this kind of looks like as you compare these cycles. And there's something I want you to take into this. The first thing is that we cannot ever predict what's going to happen in the future. Nobody can. Doesn't matter how many charts and how much wizardry you can do. Nobody can predict the future. This is just an unfortunate part of being a human. Now, whilst we can't predict the future, what we can do is use human being psychology and the way that we behave as part of our mental model. Why? Because humans are predictable. This is why things like technical analysis, whether you're charting things back in the 1920s or charting things here in 2022, many of these patterns and the human behaviors tend to play out in the same way. And the beauty of on-chain data is that we can actually visualize this and see it playing out in far more granularity than just technical analysis. So that's really what the angle I want to come at this from. We're looking at the predictability of humans, not so much the predictability of the future. Two different concepts, and breaking them apart will help you along the way. So to start off with, in terms of price action, we are still in this consolidation range. The market is digesting this significant move. This is now the second major leg, obviously coming down from 30,000 down to the 20,000 realm. And we have now been consolidating for a number of weeks. So the market is just digesting this move. We tend to see this over time. You get large moves in one direction, and then the market takes time to actually digest that move and find some kind of equilibrium. Now, what I want to start with is a bit of price structure. We're looking at the drawdown from all-time high chart. Now, 2018 and our current cycle are the closest analogs, the reason being that we have a mature market. We could go back and look at the 2015 market, the 2011, 2012, even less so, but it was just a very, very different beast back then. We still had derivatives back here in 2018. We can really compare these in a more similar structure to previous market history. You'll see that we'll do this quite often. Now, you may have heard the saying that history doesn't repeat, but it does rhyme. Now, when we look through 2018, I'm not sure how many of you were there. This was my first bear market for Bitcoin. And what we had was this kind of floor that started to form around the 6,000 level. Note that this drawdown level was essentially constructing this base level, which as we came into November, finally gave way. We lost an additional 50% of our value. And then we spent about 5 months forming this low down here on the bottom between 3,000 and 4,000. Now, in our current market cycle, we kind of had a similar pattern, although it may not look the same at first view. So we had our initial floor that was set back here in May, June, July. We set 29,000 on the initial sell-off after the first all-time high here in April. So we traded down to 29,000. We formed this base for about 3 months where we actually went back down and retested the wick on that first sell-off at 29,000. And we then bounced up and actually set 2 new all-time highs. Now, in many ways, this actually resembles similar to these big relief rallies. We've mentioned in previous videos, we didn't get any kind of bull market follow through. It really was somewhat of a dead cat bounce. It also has a lot of similarities to 2019, which is similar. We came up, we actually didn't break to new all-time highs, but certainly at the time it felt like we were going to. And then we went back into another long duration bear market that was finally ended with March 2020. So this rally had similarities to both 2019, but also to some of these powerful relief rallies we had in the 2018 bear. And you may note that we came down and we actually retested this 29,000 level, and then we finally broke it and we took out about 40%. So what we can see here is it's actually got a similar market structure where it started to belt out a floor back here at 6K, here over a much, much longer period and somewhat of a different chart pattern, but it really was forming around that $30,000 to $29,000 realm. That was kind of very, very similar in nature to that 6,000 level. Lots of people thought that's the bottom of this cycle. It's not going to give way. And then of course we did. We had lunar sell-off and then we had the next sell-off here on the 18th of June. So really there's a similarity here. And again, it's never going to repeat, but it does rhyme in many ways. We see similar properties, similar capitulation potential. The overall behavior is not too dissimilar, even though this time is always different. Now, if we come and look at this on this redistribution, so the URPD is actually a really powerful chart for actually mapping out that process. Now, before we actually jump in, there's some gifts down below I want to talk about with the 2018 and our current cycle, so we actually see how this behaves. But the thing I want you to take away from this is that during bear markets, the important thing to happen, and the reason that they take time, is there has to be a redistribution. So coins that go into certain, whether it's a trader or someone who doesn't really have a very high conviction, coins can bounce around between these. These are like the liquid supply, the supply that's always changing hands until eventually that coin finds a hodler who will take it off the market and put it into cold storage. They're the folks who are more price insensitive. And you can see a bunch of them up here. These coins still have a cost base of 50, 60,000. So these folks, I mean, we're now trading down, we've got down to 17.6, but we're trading down around 20,000, and these folks are still hanging on to their coins. Now, some of them may well capitulate. We're going to explore that shortly, but some of them also just simply don't care. They are price insensitive. They actually do believe that Bitcoin has a much, much longer future ahead of it. So over time, these coins will eventually find new holders, those who will take them off the market. And what we can see is we form these kind of volume nodes. Now let's explore this from a few different angles. So the 2018 market in particular, I mentioned that we had the 6,000 floor. This is that first level before we lost it down to 3K. So coming off our all-time high, note how we get a filling out. This is the bear market, the 2018 bear, chopping around, forming. Look at all this volume that builds up at the 6K level. So let's watch this play through again. You'll see this is the bear market, right? People haven't quite worked out it is the bear yet. Now people are starting to realize, oh, 6,000 might be the low. Look at the accumulation. And then we lose it in November, and look at all of this volume that forms down here at 3K. That's what put the actual bottom in. So everyone thought that the bottom was in at 6,000. Turns out that it wasn't. And we saw that next leg of major accumulation. We saw a capitulation and accumulation at the same time. So now let's move to our current market. We have a similar structure. So we're coming down from the all-time high. Note how we start to build up a lot of, see all these coins moving in around the 30,000 level? It starts to build up both a 40,000 psychological level, 30,000, another level, and then down here at the 20K, we had this sell-off. But remember, this is fairly recent. We've only been down here for a few weeks, but you can see how much volume starts to pick up here. Now, the other thing I want you to note, where do these coins come from? Note that they generally come from the 30 to 40,000 realm. That's where a lot of these coins, when they come down here, you'll see these start to deteriorate. So what we're seeing is that redistribution from people who bought during the 2021 and the 22 cycle. They start redistributing their coins to new holders in significant volume. So again, this is very, very early in the piece. Doesn't mean that the bottom is in, but we're seeing that people are treating that 20,000 level much the same as the 3,000 level was back here in 2018. So that's really describing that changing of hands, how coins are essentially moving between different holders, finding a new home, and eventually they will find a hodler, but this does take time. And remember that initial flush out that we saw down to 20,000 was obviously driven, as we saw, by people who had accumulated their coins at 30, 40, 50, and even 60,000. So when we look at that, a lot of those were long-term holders. Remember, long-term holders is 5 months ago. And really at this point in time, that's more or less describing the entire 2021-2022 cycle. Now we have two metrics here describing our long-term holders. The first one is our SOPR, which is spent output profit ratio. The way to think about this, if you've got a value of 2, it means that long-term holders are realizing 200% profit on their initial cost basis. They bought at 10K and they're selling at 20K on average. So that's a 200% of their cost basis. So it's kind of this profit multiple. Now, when this trades down below 1, which you can see really only happens towards late stage bear markets, it happened in 2015, happened in 2018, very, very briefly here in 2020, and you can see here that we've now broken below. So this is now indicating at a value of 0.67, that means that on average, the long-term holders that are spending their coins are realizing about a 33% loss. Now, the current long-term holder cost basis, the realized price, is only trading about 6% higher than our current price. So if the average cost basis is 6% higher, but the average long-term holder who is spending, that's what this one's showing, the spending behavior, not the unspent. The spending behavior is realizing 33% losses, which is much larger than the 6% that everyone is underwater on average. So what that's telling you is most of the spending that's going on during this capitulation is from higher up in the cycle. People with a higher cost basis are the ones capitulating, which makes sense. And the takeaway point there is that people from previous cycles, 2018, 2019, maybe even 2015, they are much, much less in terms of population of people who are spending. So what we are seeing is a capitulation of those long-term holders from this current cycle. We explored this actually a couple of weeks back. We looked at and actually broke down and captured that within this narrow window, most of the coins that are 2 years and older, they're pretty stationary. It's coins that are within current cycle that are really contributing to that sell side. Now that's the spent side of things. SOPR is a spending metric. What is the cost basis or the profit or loss realized by coins that are being spent? The MVRV is then the unspent portion. This is looking at all the coins that they still hold and they're hanging on to. Now, this will trade down below 1 when, on average, the average long-term holder is underwater on their cost basis. So you can see, very similar to SOPR, we have them underwater during the bottom of the 2015, the bottom of the 2018, and very, very briefly for March 2020. And here we are just entering this realm. Now, the other thing I want to highlight is that when you take an average of the 2015 and the 2018 period, and even the 20 back here in 2012, it's approximately about 180 days that we spend below these levels. Now, we've been down here for about 30 days. So 30 days out of an average of 180, a big takeaway from this is that it's likely we have time ahead of us, even if we do start to form a bottom. We don't know if we are, but even if we were to form a bottom, historically speaking, it takes time to actually flush that out. As I mentioned at the start, the market needs to digest these moves. Bottoms don't get put in just instantaneously. Well, sometimes they do, like March 2020, but as you can see in Bitcoin's history, most of the time it's a long multi-month process because the market's uncertain. It doesn't know where it's going to go, and we need to go through that transitioning. Those coins need to find a hodler and get taken off the market, and that just doesn't happen overnight. So we're about 30 days into what could be, on average, about a 180-day time period. Remember, history does not repeat, but it does rhyme. We're just trying to look at all the different bits of information that can help describe what may be on the road ahead. Now, we looked at those two metrics. That's long-term holder spending and long-term holder holding. And both of them right now are underwater. They're both losing money on the coins they're spending, and the ones they didn't spend, on average, are also underwater. And that's what this long-term holder capitulation tool is looking at. We're actually mapping out the blue zones are when they're spending coins that are underwater. And then we have these green zones that are showing when both their spending and their holding is both underwater. It doesn't happen very often, as you can see, but you can see 2018, it really described this low patch. And here we are 30 days into what looks like a capitulation zone. It looks like we have similar market structure to previous cycles. Also note that our MVRV did dip much lower. Note here that in 2015 and 2018, we got quite a bit lower. These got down to 0.65 and about 0.65, meaning that long-term holders were underwater by 35%. Here we are currently sitting at about 0.95. So rather than being 35% underwater, they're about 5 to 6% underwater. So you can see that the damage isn't quite as significant for long-term holders just yet, which can also describe why this can take some time, and it may also describe why the bottom may not be in. We may still need a little bit more pain, a little bit more time, because both time and price are both subjects of pain. People get bored in these markets. That's why during this 2015 market and during 2018, lots of people just lose interest and they walk away. They go, this thing is never going to recover, because the sideways action is so boring and so challenging to sit through that people lose patience. So this is also one of these things that tends to happen, not only in Bitcoin. This is typical market psychology. We see this across many assets through history. Now, what this chart is looking at is the coin supply as held by short-term holders in red, long-term holders in blue. Now, the lighter colors are those that are held in a loss, underwater on their position, and the darker colors are those in profit. Now, let's look at 2018 again. Note just the short-term holders. Note how their supply in profit pretty much diminishes to zero at the bottom. We've essentially gone through this process where they get a relief bounce back into profit and then they get wiped out. They get a relief bounce, wiped out, and this continues until there's just simply no short-term holders in profit left. Now, during that time, long-term holders are accumulating and hodling their coins, but even their profitability, look at this decline, how it keeps getting lower and lower, and then eventually long-term holders at this point in time held 34% of the coin supply, and they were holding it at a loss. Now, what we do need to see is this transition of coins from those lower conviction to higher conviction. Now, this does happen. These long-term holders have a much higher conviction, even though some of them do capitulate. On average, what we see is that they have a much higher conviction in the asset. They're more likely, not guaranteed, more likely to hold on to their coins for the long term. Now, here we are in our current market structure. Note that we have a similar structure. Here's our short-term holders coming back into profit. It wasn't quite this spiky behavior we had here in 2018. It was more of a very, very long 3-month-long rally. And then we've collapsed, gave them another relief bounce, and then collapsed and collapsed. So we're in a very similar pattern, simply in terms of the profitability of short-term holders. During that same time, our long-term holder supply started to climb, and here we are watching their profitability decline, 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 until they currently hold 28% of the supply at a loss. So 28% versus the 44 or 45%, again, you can see they're not quite at the same level of pain. A similar market structure, but not quite the same level of pain. Also doesn't mean that we're going to get there, but it's also something to just be aware of, that we have been in worse positions in the past. So now we're going to look at two different things. One is, what does a recovery look like? What we've really described above is that we have a lot of the capitulation signals. It looks like a lot of the pain is out of the system, but it also may need extra time. We're 30 days into an average of a 180-day process. So it's there, but it's also not there at the same time. We're kind of in this in-between phase where the market kind of needs to prove and hammer out the bottom before we can be confident that it gets put in. Now, what this metric is, this is actually a new metric that we've introduced in this week on Chain. This is mapping out something called skewness. So let's describe this. So in the Bitcoin transaction set, and you can probably imagine this, there's a lot more $100 size transactions than $1 million. So yes, the $1 million transactions are much bigger in size, but there's fewer of them. This is what we call positive skewness. And what it generally means is that the average transaction size in dollar terms is much larger than the median. So those who aren't familiar with statistics, the mean is the average, whereas the median is the most common. It's the one that we see the most often within that transaction set. So the median is typically a lot smaller, and that's really describing, when we're looking at median transaction volume, that's describing small entities. You may hear them called as shrimp or crabs. We're talking about smaller size entities on chain. There's more of them, but they are moving less value. In the red, what we have are the whale sizes. They're better described by the mean because they're large size transactions. Even though there's fewer of them, they're so much larger that they carry a lot more weight and they influence the average a lot more. But what you can see is they tend to move in tandem. You can see that these tend to move, and during the end of bear markets, look at 2015, they start to bottom out, the transaction size shrinks and shrinks and shrinks, and then we finally start, look how this starts to trend higher as the bottom is forming. We're seeing this recovery. More people are coming in. They're willing to invest more money. They're willing to accumulate at heavier rates. And then the bear market ends when we get a very large burst of activity. 2018, we had our collapse. Note how this descends, and it starts to bottom out and recover at the bottom. Note that we start to get an upwards trend and a burst of activity into 2019, much the same through that 2019 period. Now, there's something I want to highlight. The first one, there's actually two things. The first one, on that same trend, we've had our bull market and we're now in the phase of descending, but we haven't yet started to recover. Although note these two large red spikes. Let's actually zoom in on our current market structure so we can see it. So the first takeaway is we haven't quite bottomed out. It's actually similar to what we saw with our long-term holders. We haven't yet hit the bottom. We're in the process of forming it. And it doesn't mean that we're at the bottom or we've seen it. What it's telling us is that we haven't seen that recovery just yet. So this is a metric to really pay attention to if we do start to get that recovery out the other side. But the other thing I want you to note, we saw that the blue and red really were correlated through most of the previous history. Look how much higher the red, which is the mean, the average, the whales, the bigger entities. Look how much larger it was all through the bull, and then during the lunar, and then our most recent capitulation event. This is describing institutional money flowing through Bitcoin. Through all of history, we've seen large and small tend to move in tandem, with the exception of this market cycle. The average behavior, the mean, was much larger and has been for almost all of it, both on the upside and on the capitulation to the downside. So we have absolutely seen that there are more of these larger entities within the network. You can actually see how much this stands out relative to previous cycles. So this could be because smaller entities are actually trading in other coins. It could be that there's more of an interest outside of Bitcoin. It also could be a result of there being more institutional interest in Bitcoin because it has the size, the liquidity, and also the regulatory clarity. So we're seeing these two different things, and there's probably multiple layers to it, but they're just two ideas as to why we may be seeing this discrepancy playing through. But you can really see that this is describing that institutional shift that we have seen in Bitcoin as an asset, particularly through this cycle, and it is something that's unique to this cycle. So the last thing we're going to focus on is the mining cohort. Now, miners are very, very long Bitcoin. They have purchased an enormous amount of CapEx or capital equipment, and that can really only be used to mine Bitcoin. It doesn't actually have any other purpose. You can't use ASICs to do anything else. So when they start to come under stress, they're so long Bitcoin that when we see them under stress, it starts to move into that capitulation phase. We're getting through the forced selling. Everyone who doesn't necessarily want to sell but has to sell to cover their bills. And this is part of that process of reaching seller exhaustion. Now, what we have here is a two-part model. We have the Puell multiple in orange, which is their income stream, looking at their current income relative to their yearly average. Now, when this descends down to a very, very low level, it means that they're earning less relative to what they earned this time last year or over the yearly average. Now, we also have in the background here this purple curve, which is the difficulty ribbon compression. So where the Puell multiple is us saying, well, they're earning 40%, 60% of what they did over the last year, we assume that they're under some kind of stress. It's an implied model. But the purple curve is actual observation of difficulty compression. So these yellow zones are actually describing when both the Puell multiple is low, meaning their income is most likely stressed, and we're seeing an actual switching off of ASIC rigs and hash rate is declining such that we're getting a difficulty ribbon compression. It's a dual model. We're implying that they're under stress, and then we're actually seeing difficulty coming down, which is almost confirming that there is mining stress, because you wouldn't switch off your rigs really for any other reason, except for an instance like the Great Migration we had last year. But what we can see here is these yellow zones typically show up near the bottoms, right? March 2020, we had a double halving. Their income halved in March 2020, and then we had the actual halving soon after. So they kind of got hit with a double whammy, which is why you've got these yellow zones showing up here. You've got the 50% descent in profitability over that November 2018 period. And here we are starting with Lunar, the first halving and the second halving that we've now had. So we have essentially come down from that 40,000 level in two legs down to 20,000. We've halved their income, and here they are with implied and actual minor stress underway. And to close out and actually confirm, so we've now got a model that says it's probable that we have also minor income stress and minor capitulation. And here's those same levels, and you can see that we've had a large amount of minor distribution. This is their overall net balance. Note that their balance has been on the climb through most of 2019 all the way through to 2022 and has recently started to descend. So they're selling something on the order of about 3,000 to 4,000 coins per month at the moment. So we are seeing that their balance is declining at the same time. So when we stitch all of these pieces together, we have lots of signals of a capitulation in play. It looks much the same as what we saw back in November 2018. The big difference is that we don't quite have as much pain as back in 2018, and we also haven't gone through the duration element. So it's just one of those things to be careful and cautious that some of these things will look like bottom formation. And again, we may look back in 6 months ago, yes, that was actually a bottom. But we also have to be very aware that we have to go through the process. Bottom formation is a very, very challenging market structure. It's why no one can really call where the bottom is because there's so many elements and forced sellers and so many challenges that go on. But what we're trying to use is the data here to explore this concept and see it playing out with as much clarity as we can. So thanks for tuning in for that, folks. Hopefully you found this useful. I would recommend that you pay attention to this small and large entities chart. You'll be able to see this with anybody who has a T2 advanced subscription for Glassnode. And what we're really looking for is this recovery phase. We're looking for both small and large entities to start growing their amount of activity, seeing that starting to come out of the bear market on a median and mean basis. So as we've described, we're kind of forming this bottom formation pattern. We don't know if we're there yet. We've still got potentially some pain ahead and also a duration component. But what we do have is a series of data suites we can use to actually track what's going on, whether it's with miners, long-term holders, and what's going on everywhere in between. So hopefully you found that useful, and I'll see you in the next one. Cheers.